In this video, I will show you how to avoid two common mistakes we see small businesses making in their bookkeeping. Specifically, we will cover the correct way to reconcile your bank statements and how to keep your accounts receivable report accurate and clean. I'm Kristie Van Pay with Prosperity Bookkeeping, and we take the guesswork out of small business bookkeeping. Before we jump into today's tutorial, please be sure to subscribe to our YouTube channel, throw us a thumbs up, and if you are in the learning mood, visit our blog and subscribe to our newsletter to receive monthly tips and tricks. The link is in the description below. This tutorial video provides solutions to two of the most common bookkeeping mistakes we see, as revealed in our recent video, 10 bookkeeping blunders to avoid for better bookkeeping. I recommend checking this video out if you haven't already watched it. I will link it in the description below. I will also note that this is a video compilation of two earlier videos on reconciliations and accounts receivable. Each of those videos goes a little more in depth than this compilation, so I will link those in the description as well in case you want to go deeper into any of these topics.
So let's jump right in with what is a reconciliation. A reconciliation is a verification of numbers on a financial statement to a verifiable source, like a bank statement, a loan statement, or maybe even a credit card statement. It's kind of like balancing your checkbook. So if you ever learned how to do that, maybe in high school, if you had a consumer ed class or something like that, where they taught you how to balance your checkbook, that's basically what you're doing, but you're doing it for a business. So I have an example here of a bank statement. And what this is telling me is that at the beginning of June, I had $21,000 in my checking account, but then I made 7 deposits and I made 50 withdrawals. And at the end of the month, I had $3,000 left. In order to tie this out is I would complete a reconciliation in my accounting software to get my numbers to come out and make sure that they're the same. The type of reconciliation that we're going to be talking about today can be done on a bank account, it can be done on a credit card account, and it can be done on a loan account. And actually, all of them are very important. So if you have all three of those things, then you should be completing reconciliations on all of those accounts on a monthly basis. So let's dive into what a reconciliation looks like using QuickBooks Online. And this is going to be just a really brief, it's not going to be an in-depth tutorial. So what we have here is that same bank statement that I had showed you earlier, where we have a beginning balance and an ending balance. So if we're going to complete a reconciliation in QuickBooks Online, the first thing that we want to pay attention to is the beginning balance, because we want to make sure that nothing has changed since the last time we reconciled our account and that our beginning balance is still correct. So if we go into QuickBooks Online here, I'm just going to move this over. We go to the gear wheel and we click on Reconcile. And I just want to point out that this is going to be a reconciliation if you're doing manual data entry. So you're not using the bank feeds. You don't have QuickBooks Online connected to your bank and it's automatically bringing in transactions. This is manual. So if you do have the bank feed connected, then all that changes really is that some of the transactions will already be marked off for you, because when they get entered from the bank feed, then it knows that it came from the bank, so it automatically checks it off as being verified with the bank statement. So you're going to click on Reconcile under the gear wheel here, and it's going to bring you to this screen, and then you're going to choose the account that you want to reconcile. So we're going to do a checking account, and we want to confirm that beginning balance. So, well, first of all, we want to make sure that the last time that the account was reconciled, that we have the statement following that period. So we have our April statement, and actually when I bring it back up again, you'll see it's a June statement, but this is all just for demo purposes. So the last statement ending 3/31. So our beginning balance was $21,281.83, and we want to confirm that over here. So we have $21,281.83. Okay, so we're good to go. Now we need the ending balance, $3,191.14. And then we want to put in our ending date. So in this case, it's going to be the end of April. So 4/30/21, and I'm a year behind. And let's start reconciling. Okay, so now what you would do is you would look at your bank statement and you would check off all of the withdrawals and all of the deposits that match here. So you would just go down the list and check them off as you see them on the bank statement. And when you get all done, you should have a $0 difference here. So for the purposes of this demonstration, to keep it short, I'm just going to quickly run through this. I already know what cleared and what didn't. This did not, and there was a deposit. Okay, and that did not clear. Okay, so I've checked off all the things that were on my bank statement. It says I have a $0 difference. So we have everything checked off. We're at a $0 difference. We've investigated all of our uncleared transactions, and we are complete. We can click Finish Now. And we're done with this reconciliation until the next month. If I asked you today how much money your customers owe you, would your answer be accurate? When you look at your balance sheet, you may notice that there is a line item on there called Accounts Receivable. That is the balance owed to you by your customers. So it's sales that you've made but haven't been yet paid for. But is that balance accurate? There are probably numerous reasons that this number could be off, but the three that we're going to cover today are old balances that have been deemed uncollectible. Number two is old customer credits that have not been paid back or cleaned up. And number three is prepayments or down payments. Let's start with number one, old balances that have been deemed uncollectible.
Okay, so how do we write something off to bad debt? So let's say, for instance, we're looking at our accounts receivable aging summary report. And we are looking here at Red Rock Diner. And Red Rock Diner has unfortunately had to close their doors, and they will not be paying us the balance due of $226. So we want to write that off to bad debts. So the first thing that we need to do is, if you have not written anything off to bad debts in the past, you may not have all of the accounts and items necessary to do that. So the first thing we're going to do is set those up. So I'm going to start by creating, because it's going to kind of kill two birds with one stone, I'm going to create a bad debt item. So if you go to the gear wheel, and this is a sample company I'm working in here, but if you go to your gear wheel and you choose products and services, we are going to create a new item. We'll make it a non-inventory item, and we're going to call it bad debts. Okay, and then we don't really need to fill in any of this other information, but what we do need to fill in is the income account here, which it's actually going to be an expense account, and we're going to create it right now because we don't currently have one. So we're going to scroll all the way to the top, and we're going to click on Add New. And then this is going to be an expense, and the detail type is bad debts. Okay, and that's calling it bad debts, which is fine with me, and we're going to save and close that. Okay, so that's the account that we want this item to go to. So now we're going to save and close. And then the next step is going to be to create a credit memo for the amount that we will not be able to collect from Red Rock. So I'm going to go to my Plus New button over here, and I want to create a credit memo. We're going to select the customer, Red Rock Diner, and you want to make the credit memo in the current period, because if you've already closed out prior periods, you don't want to be making changes to those periods. So if you've already reconciled your books for last month, then you want to make the date in this month, okay? Don't use the date of the original invoice. You want to keep it in the current period. The other reason that this is important is because if you do sales tax, if you pay sales tax on any of this stuff, then you want to have that change reflected in the current period so that you don't have to amend a previous sales tax return. So we'll use today's date, and for the product or service, we're going to choose bad debts, and the quantity is just one, and we're going to put in the full amount, $226. Even though they have multiple past due invoices, we're just going to do one line item for the full $226. Now, I do know that those particular invoices were not taxable, but if this were something that you were writing off for a customer and it was originally taxable, then you're definitely going to want to leave the tax box checked, because you want to get credit on this next sales tax return that you're going to file for the money that you weren't able to collect, because you've already paid sales tax on that and you want to get that back. So you're going to want to leave that checked so that it affects your sales tax liability. But in this case, there was no sales tax, so I'm going to mark that off, and I'm just going to save and close. And then there's one more step that we have to do, and that is to apply the credit memo to the open invoices so that it comes off of our accounts receivable report. So the next thing we're going to do is receive a payment. So plus new and receive payment. And we are going to type in our customer, Red Rock Diner. We're going to leave the date as today's date. Actually, did it already record the whole transaction? Okay, so I went to my accounts receivable aging summary report because I just wanted to see if it had automatically applied that bad debt credit memo to my customer's open invoice balance. And it actually appears here that it did do that because Red Rock Diner is no longer in my list on my accounts receivable aging summary. So if you have it set up in your settings for credits to automatically be applied to open balances, then this might occur for you. And I'm suspecting that's what's going on here. So I'm actually going to just check my settings because I do want to show you how this will work if it's not going to automatically apply, because I usually recommend having that setting turned off. I think it's leaving too much to chance, and it will probably apply credits to the wrong invoices, which will cause confusion for you and your customers. Okay, so that is actually what's going on, and I just want to show you in case you have this and you want to check your settings. So if you go to the gear wheel and you go to Account and Settings, and you go to Advanced, and you scroll down to the automation section here, you see where it says automatically, where did I go? Automatically apply credits. That's turned on right now. I want that turned off. So I am going to actually, pre-filling forms is fine. I don't want the credits automatically applied. And I also really don't want bill payments automatically applied either. I want to have control over that. So I'm going to save that. And save my changes here by clicking done. And then I'll show you how to actually apply the credit memo to the open invoice to remove them from the accounts receivable report. Okay, so looking at the accounts receivable report, I just created a credit memo to bad debts for Jeff's Jalopies here. So now you can see that he had his original balance of $81 and then there's a credit here. So what we're going to do is apply the credit to the open invoice so that it removes itself from this report. So we are going to go to New and Receive Payment. Okay, put in our customer's name, today's date, or whatever date you created the credit memo is fine. And then you'll see here that you have the open invoice, and they've already checked it off for you, and then you have the credit memo that you created for the same amount, and it's already checked off. So this is creating basically a $0 receipt. So we're just going to go ahead and save and close that. And then if we go back to our accounts receivable report, we will see that Jeff's Jalopies is gone. Okay, so you see he is no longer there. So that is how we write something off to bad debt once we've determined that it cannot be collected.
So moving on to item number 2, old customer credits that have not been paid back or cleaned up.
Okay, so you need to refund a credit to a customer. Maybe they overpaid you, or maybe you created a credit memo for them at some point and then they never did business with you again, so then they never were able to use up the credit memo, and now you need to refund the customer. So for this particular example, I'm just going to assume that the customer overpaid us. So this customer owed us $629.10 for some services that were performed, and they sent us a payment for $650, which is an overpayment. This is going to create a credit of $20.90. So when I save this and I look at my accounts receivable report, I'm going to see a credit on their account for $20.90. Okay, so here's my customer and here's the credit. Now I need to refund this credit. So what I'm going to do is I'm going to create a check. If you guys print your checks out of QuickBooks, you would definitely want to do it as a check. So I'm going to do it as a check. Okay, we're going to put in our customer's name and today's date. So we don't want the original date of the invoice. We want today's date. And we want to put this to accounts receivable is where we want to post this. Okay. And we'll put in the description refund of overpayment, and the amount is $20.90, and the customer is Gita. Okay. So now we're just going to print this check or write this check out if we hand write them out of our account, or if you Venmo them, whatever the case may be, you're going to issue the payment to the customer. We're going to save and close this, and then we need to go and apply this to the customer so that they are removed from our accounts receivable report, because now you'll see that this amount changed to 0 because we now have a positive amount and a negative amount, which equals 0, but we want them not even to be on this report at all. So again, we're going to go to receive payment, and we're going to put in Gita. Today's date is fine. And you'll notice here that we've got the original credit. Actually, this is the check that we wrote out to them, and then the original credit amount, which was the open balance of $20.90. And with they're both marked off, essentially creating a $0 receipt, which is exactly what we want. And we're going to save and close this, and then Gita will no longer be on our accounts receivable report once this refreshes. Okay, Gita is gone. So that's how you do it.
And then finally, the last item that can affect the balance would be if you collect prepayments or down payments from your customer. I have another video on how to handle down payments and prepayments, which I will link in the description below.
I have walked you through the process of reconciling your accounts and cleaning up your accounts receivable. But if you want to learn more, visit our blog and subscribe to our newsletter to receive monthly tips and tricks. Oh, and don't forget to check out the videos that go more in depth about each topic linked in the description below. If you found this video helpful, please don't forget to give it a thumbs up, and if you haven't already done so, subscribe to the channel. If you have a question about what we covered today, someone else might too. Don't be afraid to ask it in the comments below, and we will do our best to answer it for you. Thanks for watching, and see you next time.